David, thanks for joining us today. You are one of the most prolific angel investors in existence, I believe. What drew you to angel investing, and what's kind of like the story there of how you got into it?
Yeah, so I had a couple of good outcomes as an entrepreneur. I've been an entrepreneur my whole life and had one job interview, uh, and I'm 1-0, I like to say, on job interviews. But then I started starting companies and had a lot of fun with that. And after having some luck and some good outcomes, really was attracted to this idea of angel investing, where you can find others to share experience with and share upside with. And started looking into that, going to some angel groups and things like that. But it was all pretty dissatisfying. It was, I made, I don't know, a dozen angel investments. Some of them did okay. I learned a lot from them, but it wasn't super satisfying, which is why I ended up creating Techstars to do it, more as a professional angel investing, if you will.
Yeah, tell us about the Techstars model and how it's different and how it kind of scratches that itch that independent angel investing didn't.
Yeah, I think that what most angel investors do when they get started is they look around locally for some companies that are interesting intellectually to them or have some people they like involved. And what I found is that for most angel investors, it's really the practice of taking a large or a medium fortune and trying to turn it into a bigger one, but ultimately probably turning it into a smaller one. It just is very hard to do. And the reason it's hard to do is you don't make enough investments, you don't have enough network, and you don't, run into enough of the most interesting opportunities. So when I had that experience with angel investing, it was dissatisfying. It was going to a coffee shop and meeting an entrepreneur and being pitched on something, and you know, writing a $50,000 check and then never hearing from them again until they needed more money. Right? It was typically the experience, and I wanted to help more than that. I wanted to be more involved in that. So I came up with Techstars in 2006 as an idea to be more hands-on as an angel investor, to make 10 investments at once and to bring those 10 companies where I am, which happened to be at that time still is Boulder, Colorado, and be really hands-on with them and spend 3 months with them, almost kind of living with them, right? And sharing experiences every day so that I really get to know them, helping them learn how to leverage my network, bringing in the networks of others. And, we didn't have a word for it at that time, but eventually we came up with the word accelerator. And Brad Feld, who's one of my co-founders at Techstars, came up with that word to describe this kind of activity, which really we were one of the first to do, and really did it in a very mentorship driven, community oriented way. And so it was just more satisfying as a way to get to know entrepreneurs and to decide afterwards if we wanted to put, more money into those companies. And obviously it's scaled quite a bit since then.
Let's talk about mentorship. I was looking over your blog, and I know that's a really important topic for you. And I really enjoy that as well. When I was doing traditional venture for 10 years, that's probably the thing that I love the most about it. I'd love to talk a little bit about how your experience as an entrepreneur teed you up to be a mentor, and how much of that mentorship is really, talking people off a cliff and helping them to see risk and fear as opportunity, which is kind of the theme of our podcast.
Yeah. Well, I mean, everyone has their own mentors in their early career. I hope everyone does, because it's really a game changer to have people that care about you and want to open their networks and open their experiences to you. For me, my first one was my dad. He was a CPA, had his own accounting firm. And I used to work in that firm as a kid, and, I got interested in computers, and he would, help me understand business, right. And sort of get into things. I would ask questions, how does a, accounting ledger work? And what does this mean? Like, what is a tax, right? When I was a kid, asking all these questions, and he was the original mentor for me, and he was an entrepreneur, and I sort of respected that he had built his own company and his own business with his name on the wall, right? So, and on the door. So it's pretty cool. Later in my career, there would be different people that would just go out of their way to give first to me, just be helpful to me. And they didn't really want anything in return other than to see me be successful. So it was powerful in many contexts. I remember selling my first company and never having sold a company before. Talking to someone like a Bradfeld or someone more experienced that today I might have that experience having sold hundreds of companies in our portfolio. Reaching out and saying, "What do I need to think about?" And I feel like we probably doubled the exit value of our company from that type of mentorship in a few 30-minute phone calls. How to negotiate it, how to position it to be more powerful for the acquirer, how to work through, when to decide to push for something or not. And, that's the power of mentorship to me is an hour of somebody's time, doubling a multi-million dollar exit. We see that every day in Techstars now, right? The mentors have that kind of impact. And when entrepreneurs say to me, is it worth, a few percentage points of the company? It's like, yeah, you got to surround yourself with these mentors and advisors that have been there and done that. And it can pay off in very meaningful ways in really specific moments along the way.
Yeah, you make me think. I mentor a few crypto startups right now, and we did one of them is launching their Series A, and they text me just last week. I was in the middle of a walk, and I got this text. Can you hop on a 15-minute phone call? And it was essentially
Yeah.
just them wanting to talk about the fundraising strategy in general, but a lot of it was also just keeping their head right, their mindset where it needed to be. There's a lot of trepidation, a lot of fear as you're entering raising capital, especially in a bear market or not the ideal terms. And a lot of it is that mentorship is really just kind of being a voice of reason. And I found we all need that, right? It's like Michael Jordan needed a coach because having that sideline perspective is invaluable.
Yeah. You have a zillion things going on in your head when you're in the middle of a deal or in the middle of a business and you're trying to make things happen. And typically it's one or two things that really matter. Right. And I love the sports analogy where the coach can say, just keep your head up. Right. Like,
Right.
or be positive. Right. Because you're signaling negativity to the rest of the team and that's affecting them. Right. And it's little things in big moments. I think that's what mentorship is all about. It's sure you're going to get advice along the way, but it can be really little and specific things in really big moments for you that can make all the difference in the world.
Yeah, and that voice is so important, I think, especially in entrepreneurship and in investing in sectors that people may not understand, because in general, the public tends to be negative towards things that they don't understand or that aren't popular at the time. So if you're a startup founder, probably most of your family and your outer friend circle is thinking, what the hell is David doing? Like, this is super risky. It's probably not going to work out.
Yeah.
And you need that inner voice. And really, I think that community, I think that's also what I've noticed that Techstars brings to the table is a community of like-minded individuals. One of the things that I think was big and probably is still big within Techstars is, celebrating failure and just that mindset and how different that is than what most of society thinks, right? Most of society believes it's all about success and failure is a side consequence. It's not a catalyst for future success.
Yeah, it's a part of the process of entrepreneurship. I'm always skeptical of entrepreneurs who never have any failure.
Right.
My favorite type of entrepreneur to back as an investor is one who has had success, probably not a big one, but some success, then a failure, because we know they can do it and they're really pissed off about it. Right. And so they're going to go and do something big. Right. But it's a thing that happens in entrepreneurship. And, when we have companies that fail, we've literally had, wakes for them. Right. And said the company is dead, but what an awesome experience. And you celebrate the company and literally, have parties in the street or whatever. And those people go on to do amazing things because their community is supporting them in a moment of need. I've literally I've gone on a trip to Tokyo with an entrepreneur whose company I was on the board of failed. And we just hung out for 3 days and talked about what was next, right? They feel that support in that moment. And these mentorship, relationships transcend even one company, the best ones, and become very two-way. And you learn as much from the person you are mentoring as they've learned from you, or hopefully more.
That's a great point. I was going to ask you if there's a specific example or even a general example that comes to mind when someone you were mentoring really taught you something or helped you see things in a different light?
Yeah, I mean, I think immediately of several people, but just to pick one, I have a close relationship with a guy named Isaac Saldana. He started a company in 2009 uh, that was called SendGrid. Actually, it used to be called SMTP API, but we helped him change the name to SendGrid. SMTP is a mail protocol API, of course, technology to help you use it. And we said, that's just not a good name. And I felt like, we put enormous amount of energy into not just the name, but the company. And he went on to, you know, be a part of the management team and the board of that company that IPO'd, later merged with Twilio, that, another public company. Um, and I ended up learning so much from him about culture, about, I know a lot about values and building companies, but, he really had something special in that company that was very, very intentional around culture and values, and humility was one of them. I mean, I've just learned so much from him over the years, and now I see him as an investor, so it's become a two-way relationship. That's just one example. There are thousands of entrepreneurs in my world that I feel like that with. And there's another one on the other side where when I first met Brad Feld, who's my co-founder in Techstars, I felt like I was just take from him, from his, big giant brain of knowledge. Um, and now I see him writing books and saying, to someone I've learned more from than anyone. And I'm like, you're talking about me? That's crazy. It becomes two way. And so that's the sign of a great relationship, is it's not one up. It's, equal, helping each other with things in the course of a career.
Yeah, it's really holistic and rewarding. As you
Can be.
think of the venture asset class, specifically early stage where Techstars focuses, how do you approach communicating the value and the impact to LPs, especially ones that may be new to the sector?
Yeah, well, I mean, I guess we're talking about contrarian stuff. That to me, most of the venture capital industry is pretty broken. Very fee laden, very hand wavy. Very hit or miss. It's a hits business, they'll tell you, right? And venture capital, is risky. It's just a risky type of asset class. I actually think it's risky because of malpractice in most cases. Highly concentrated portfolios, large checks being written at high prices. And, we sort of came into this with this idea of just helping entrepreneurs be successful. And what we discovered as we scaled, our very early stage investing platform into the billions of AUM, right, over time, was that there is a way to invest responsibly in very early stage companies with diversification, with appropriate pricing for that risk. And it just becomes math, right? And, I think today, that's still viewed as heresy in the venture capital industry. Right now, you must have very concentrated positions of, you must sit on the boards, you must, just have 10 or 20 investments in your portfolio and go all in because there aren't that many winners. And it's a battle that we still fight every day with a lot of LPs who say, that's the conventional wisdom. And I like to say you don't really make money in venture capital with conventional wisdom very often. You have to take some risk and gamble and think about things differently. So, it's 16 years in now where, finally there's a subset of limited partners who are understanding the math of what someone like us does with 1,000 companies in a fund, right, in a portfolio, and thousands of companies that we support, and a team that's not a few partners with a crystal ball, but rather, hundreds of people working together around the world to approach something differently. So for anyone who's out there building something different, one of my heroes, my personal role model, is a guy named Jack Bogle, no longer with us, but built a company called Vanguard. No one believed in index funds. No one believed in that sort of approach. It had to be managed, and now that's the way the world works, right? And so it's a long journey, and I think sticking with it has been a lot of fun to see the results coming to bear now.
Yeah, it's such an interesting point because And I want to revisit what you were talking about the venture industry being broken. There is a point, right? And you see this in crypto as well. There is a point, whether a timing in the market or a subsector or approach within a market, where you can be in a contrarian market, but not be acting contrarian, right? You're just doing what everybody else is doing. You're investing in the same deals. Talk to us a little bit about the way that ventures broken in that sense, and what do you think the repercussions of that are?
Yeah, I mean, it starts with it being sort of a who you know business, right? It's close networks of people, and that's why we have all these challenges with diversity and things like that. Um, you have to know somebody who knows somebody, right? And uh, then the firms, many of them, they go out and they invest in 15 or 20 opportunities in a fund, and they'll tell you we need one or two that are big winners, and a lot of them are going to die. And I don't think that's thinking of it that way is necessarily helpful to the portfolio, right? You want them all to work on some level and achieve success, but more importantly, economically, it just creates enormous volatility, and that's why the asset classes is known. Venture capital is known to be the most volatile of the asset classes, the most risky. I mean, did you know that in venture capital, a manager whose previous fund was in the first quartile has an equal chance of being in the bottom half as the top half with their next fund?
Hmm.
Past performance is zero indication of future, right? They'll tell you that in their pitch, but they'll tell you also we have the right crystal ball, right? And so I think it's not a repeatable business. The firms that we all know today, many of them have gotten lucky two or three times in a row and roll the dice correctly two or three times in a row, and that's how the brand gets built. And then the next fund has an equal opportunity of being good or bad. That's the data in this industry. So I think the problem is that even for LPs who are looking for investments or family offices, they'll go and say, well, there's this name brand VC. Let's get into that fund at all costs. Let's pay their high fees. And there's really no guarantee that that's going to work. They've got to then build a diversified portfolio of managers to try to get some kind of diversification. It boils down to there's too much concentration risk in venture capital today, and there's too much sort of systemic built-in. There are many systemic built-in reasons for that that are hard to change and require a different way of thinking about it. So when people look at Techstars and see 400 employees around the world and that's a venture capital firm, yeah, it's a different kind of venture capital firm, and it's required to build something that is really focused on diversification and consistency as opposed to risk.
And you guys pick sectors kind of to focus on, right? And then you launch accelerators that have a focus, right? That basically serve that focus. Is that correct?
Yeah. So what we do is we're very early stage investors. We take, lots of risk at the early stage, but we do it with enough companies, about 600 a year we invest in and growing around the world. And we are universal investors. So we're not specific to a sector or even a geography. What we're interested in really having almost an index of what's happening out there. So the entrepreneurs will tell you what that is, right? If you're interested in AI, yep, 30% of the companies in the portfolio are working on AI, not because I'm going out and looking for that, but because we're funding the best available people in the markets around the world. So
Hmm.
we do have some accelerators that have specific thematic focuses. And we do have 15 practice areas inside of Techstars where we've organized 8,000 mentors around things like healthcare, or AI, or fintech, things like that. But some of the accelerators do have a focus like fintech that's trying to match what the market wants and partnering with companies that give us an advantage in that space. But generally speaking, what the entrepreneurs are working on will shape what we invest in this year, not an intention to be just in a particular thematic area.
Yeah, that makes sense. How about crypto? You guys had some early investments in some crypto companies that were pretty big wins. How have you viewed the space since then, and how have you observed it in its evolution?
Yes, I think that's a perfect example of we didn't go out and build a practice area right around crypto and say we want to what happened was the market said we're interested in that. Entrepreneurs were coming to us with those ideas. The challenge for us was, not being stuck in our ways and figuring out how can we invest in a token, right? Or, will our investors, our limited partners, allow us to do these things? And we've, as you said, we've had some that have worked really well, and we've had some where we quote unquote learned a lot, right? That's the nature of the beast. And so it was just being open to the opportunity, and again, we're funding the best available entrepreneurs based on what they want to work on
Yeah.
in these markets, and that's what led us into that space, like many other spaces.
Let's talk about some of those learnings. You said you had some that you've learned a lot. Let's share that with the audience.
About crypto in particular, or
Sure, but in general, I think in general it's important to hear the lessons and the insights.
yeah, I mean, I think that there were a few times in the crypto space specifically where the thing where we were investing in wasn't really the company,
Yeah.
and our interests weren't really aligned with the entrepreneur's interests. We were investing in, utility token or something over here, and they were building a business over here, and that was a component of it. And so we've learned a lot to make sure we are investing in a way always that's aligned with the entrepreneurs and aligned on their upside. It's sort of the equivalent of old school, always invest in the holding company, not the subsidiary, right? But I think you also learn, it's to me, Web3 and all of this is much more become about a way of working and a way of engaging in work in the future. It's the future of work. And really, those are the themes that have popped out more for me than it's not speculating on a particular cryptocurrency. We don't do that at all, for example. It's really trying to be aligned with entrepreneurs that see a new way of working, right? A way of working online, bringing people to the things they're interested in, to build their own career however they want to. I think that's the exciting part about a lot of this. And so, the learnings are every day in every industry. But it's funny, there are themes that repeat. You're really looking for what is the broader, sort of social or economic trend, not what is the technological trend, right? And it's so much about the people and, supporting them and being aligned with their success.
You bring up such a good point. I just spoke about this on a panel. My observation of crypto has been sort of it's growing up, and it's interesting having a VC background. It's learning lessons that I feel like venture learned decades ago, right? So in 2017, you launched these ICOs where people could launch a new token and raise a bunch of capital up front. Few lessons learned there. One, they're essentially raising their seed through Series D round all in one go. And like the data supports, I think that if you over raise, that can be as much of a problem as if you under raise. Concurrently, there was no oversight of use of funds. There was no like treasury management. There was no vesting schedules. All these things that we as people with background in venture capital and investing, we come to expect that the entrepreneur kind of has an order. That was just kind of left there. And then you're seeing now this introduction of, okay, I own a token, but what does that mean? It seems to be way worse than if I own a stock, right? Like, do I actually own a component of this company's upside, or do I just have a gift card essentially with a discount on services and I can vote on something down the road?
Right. Well, that's the alignment piece I was talking about, right? Are you investing in the context of the entrepreneurial activity,
Right.
or are you speculating in the context of something whose value might go up or down? And again, Warren Buffett, pick your favorite, right? It's investing that matters, and having a patient long-term approach, and having this thought, like, I never want to sell the thing I'm investing in. I want to see it grow forever, right? We only sell because we want to create liquidity, or we do that to serve, other interests like our own investors' interests. But, I think there's a lot of speculation that's gone on in the industry that you're attached to, and less investing. And I think we're seeing that flip now, where people are understanding the long-term investment opportunities.
Yeah. I mean, so many people, and when we think of the whole point of this podcast, it's to be contrarian to the public, but so much of the public views they should have bought something if the price goes up tomorrow, and they shouldn't have bought it if the price goes down. But obviously that's insignificant and doesn't matter. I mean, to talk about Warren Buffett principles, what matters is are you invested in something that you have long-term conviction of? And it's fascinating how few people even think that way. Obviously, in venture, you're forced to think that way because you're in an illiquid investment class. But it's really like, it's fascinating to watch how reactive people can be, and how results oriented they can be, in bias in their investment decisions.
Yeah. I mean, we face the same thing in our world with LPs, that are, again, we look like a really odd duck in the venture capital industry. I say, well, we don't, you're investing at the very early stages, so we have to wait even longer for outcomes. So say, no, here's the actual fund data and the DPI, right? Distributions paid over time and how money flows back to you. Turns out it's counterintuitive. There will be some companies that sell early, right, and generate that liquidity. And so, whenever you're faced with sort of the conventional wisdom stuff, like, I think what people do is they don't look at the data. Now that there is data in an industry like yours, or in what we do in very early stage investing, you start to look at it and understand, wow, that doesn't work exactly like the thing that I learned when I was 20 years younger works, right? And so, but you have to pay the price to trial that stuff and learn and get the data over time to understand what approaches should be taken that are real investing approaches.
Yeah, I was thinking about, your accessibility to data just internally, because you guys are so active, must bring you incredible insights and an incredible edge. Can you talk a little bit about that? I mean, there has to be just so much you can see.
There is. I think you have to have context, and just to give it. I mean, we've made over 4,000 investments
Right.
in startup companies. We've seen 500 exits through M&A. We've seen IPOs and everything on the spectrum, right? Unicorns, failures, everything. The data that you get from being on so many cap tables is really interesting and telling. It actually tells you a lot about, for example, if I have a company, we could almost train an AI model to say, well, what investors are most likely to invest in this company based on 4,000 previous companies, which probably raised 15,000 rounds, right?
Right.
And the geographies of where investors are investing. Like, here's an example of an insight that you get from AI. If you have a VC who's made one investment, let's say they're Bay Area based, and they've made one investment in Boise, Idaho, there is a very high probability that they'll soon make another investment in Boise, Idaho. Why? There's already a partner getting on a plane to go there, right? They already have a board seat there. They might as well have two, right? It's much higher than it will be in Bozeman, Montana, right? Or some other place, because the data will tell you that. So these insights pop out. We learn a lot from our own evaluation process of these companies. We've looked at hundreds of thousands of companies. The acceptance rate to Techstars is like 1.5 or 2%. So for everyone we fund, there's 50 we're not, right? And looking back on that data and how you evaluated those companies and where did they go? How did they do? Why did you evaluate them that way? Super interesting. It basically shows lots of human bias when you really point AI at this kind of data. For example, we used to score companies when we were evaluating them, sort of like, 1 to 5. Just changing that to 1 to 4 had a huge impact on our ability to select better, because 3 is this easy middle number that people can pick, right? And they do. They tend to pick it when they're not sure. So you have to create polarization, which pops out the things that are interesting. It turns out that the average score when you're evaluating an early stage company doesn't matter as much as how many people in the room gave it the top score, right? Polarizing. That's what startups are. Reactions to them are polarizing. And many bad scores and many good scores are better than lots of average scores. So this sort of stuff pops out when you look at data at scale. And we're in a position, with a real portfolio to have more data than pretty much anyone else, right? We're really the most active seed investor in the world at this point. So, it's really, really interesting to get data on contrarian topics that now becomes mature 10 or 15 years in. And you can say, yeah, that wisdom or that way of thinking about it is not actually what happens when you get data and you look at it.
Yeah, I mean, that's super fascinating. I'm sure we could talk about that all day. The insights and I mean, just the high score um, insight you were sharing is fascinating to me.
Yeah. Anybody's got to judge stuff. Never give anyone an option to pick a median number. It doesn't work
How often does it happen that you guys have high conviction of an early stage company, but the market just isn't seeing what you guys are seeing?
all the time. You know, we have equal conviction about every investment we make, but those investments are only, $120,000 investments, right? And so we do it at a very early stage, and then we spend 3 months with those companies. And sometimes they come out of it and no one cares. And that's our fault if that happens, because they should already be pivoting in the program. We should be getting them that data before they go out to market and try to pitch something. Um, Same thing happens with, there are plenty of companies where there is zero investor interest. I mentioned Isaac Saldana, my friend. When they graduated Techstars in 2009, we had a lot of customer interest, but no investor interest. No one wanted to fund this company. It raised $750,000 at 1.7 million valuation. So I had to sell a third of the company to raise a tiny amount of money. It was not interesting. A few investors sort of said, we like the people, we're seeing the market signal. But some of the biggest companies we've worked with, um, there was very little interest in the beginning, right? And they had to prove it. And so you never really know when to give up on a company. You can overreact to investor interest as well as anything else.
Yeah, I think you see that all the time, right? Is that people all want to be in, like we mentioned, the same deals that everyone's interested in, and if someone's not interested,
Yeah.
they wonder why. And I think you guys being on the front lines where you are having high conviction of these companies, even in the absence of other parties, is just a testimonial to how contrarian the organization is.
Well, but we do it with a mathematically constructed risk profile, right? I mean, it's pretty simple for us, right? We're funding lots of companies at this sort of lower prices than what you would typically expect in the market, but we're adding a lot of value with this big network, right? These companies have 15, 16 years of people that come before them that have done what they're doing to leverage, and they've got 8,000 mentors around the system to help them. So there's sort of these intangible value things that really make a difference. The brand helps them a lot. Investors take it seriously and look at it. But we get a pricing advantage for that is much better than what an angel investor would pay in the open market for the same company, right? I mean, $5 million valuation company, we might pay $2 million valuation, right? And that's a real scalable advantage that you have if you do enough investments, because 1 in 75 are going to be a unicorn in our experience based on our picking model. Um, that's a pretty high hit rate when you're investing at a $2 million valuation.
Sure.
Right?
Yeah. Do you think that entrepreneurs often intrinsically see the value that the programs bring, or do you think sometimes there's entrepreneurs that don't see that value?
I think they see it at the end. I think sometimes they see a program like an accelerator as really just a way to raise their first round. They might be struggling to raise money. Usually, there's a root cause of that that's different from just investors are stupid, right? It's usually that there's more to do to build the business or to tell the story correctly. Um, but they'll start many times thinking, well, I'm just going here to raise my seed round, and they'll come out saying, yeah, I did that, but man, the network I built is so much more valuable than that. Right? That's the real, I think, the real fundamental product of something like Techstars is the network that you emerge with, of people that are willing to help you, that that you have some kind of in with. Uh, you got a built-in customer base, you got a built-in set of large corporate clients that want to use your product. They realize these things are much more valuable than just the round they raised at the end.
Yeah, I think it's one of those things that it takes a lot of wisdom to fully appreciate. Almost like a growing up, right? Like you appreciate your parents more and more. I think the older you get, it's just like the way that nature works, and it gets really rewarding later on. And then you wanna give back in a similar way, ideally.
Good analogy. I mean, I think when you're a kid, you think, oh, this is just like, there's a roof over my head, right? And that I have some food. I have Doritos, as many Doritos as I want.
Yeah.
right? It's amazing. But then you realize later on that there was a lot more to it than that, and a lot more sacrifice, right? That was made for you.
Yeah, one of the I think most effective pieces of advice I give younger entrepreneurs and just younger people in general is to one of the best skills you can acquire is just be a delight to mentor. Because already I think people that do mentoring, they want to give back. They don't need you to add value as it's conceived in modern society. You know, like I give you a dollar, you give me a dollar worth of something back. It's that they want to help and they just want to help in a way that's enjoyable and they feel appreciated. And so I think that is
Yeah.
like the way that I think of mentorship and being a mentoree in general.
Yeah, I agree. I think if you want to be a delight to mentor, I don't think that means you should do whatever the mentor says.
Right.
I think that's another mistake that I see entrepreneurs making. What makes you a delight to mentor is that you close the loop and you say, thank you for the input. We're not going to try that. We are going to try that. We're going to get data on that versus, I give you some advice. I think you should do X, and I never know if you did X or not, right? My goal is to learn, like, did that work? Was I right? Do I get new data here that X is actually not the right approach? And so I think as an entrepreneur, when someone's trying to give you advice, the key thing is not to take it. The key thing is to hear it, consider it, and then close the loop on what you're doing so that the mentor can learn, right? And it has a closed loop system from you. It's essentially about communication. It's a relationship like any other. And then when you're mentoring people, I think it's really important to not assume that you're right,
Right.
and to talk only about your experiences and not about your guesses, right? Like the best mentors will say, I don't know all the time, but I know someone else that has done that, right? Or I did do that, and here's what I think the right approach is. Um, I don't have to be right, right? When I'm giving you feedback, it's just data, it's just input. This is one of the things in the Do More Faster book, right? That Brad and I wrote. It's just data. It could be wrong, could be right. It's based on an experience, and it's your job as the entrepreneur to decide. So I think when mentors are offended that people don't take their advice, that's not a good recipe.
Sure.
And I think when entrepreneurs feel like they have to do everything the mentor says, it's also not a good recipe.
I try to tell everybody up front that I'm having any sort of mentor relationship with is take this as an opinion, just like a doctor's opinion or a lawyer's opinion, get other opinions and make a decision because you're going to be able to make the best decision with my input and others' inputs because this is your baby. This is your area of focus. I only have a small insight into the knowledge that you have about this problem.
If somebody comes back to you and says, hey, here's the data, you were the only one that thought that. I talked to 15 other people and they all said the other thing. That's interesting to you and you learn from it and you feel good about being in
Right.
that relationship. You might feel a little dumb for a minute, but you're getting data back, right? And fine. And what if you end up being right? That's even more data that the whole market thinks it works differently, right? And so, yeah, beware of the conventional wisdom, especially when it comes from generic experience and not specific experience as well.
Yeah, I'm always I'm always skeptical of conventional wisdom. So
It made
that's
sense
a good
20
thing.
years ago, probably. That's what that means, right?
Right.
So,
Um, there's a lot of fear in the markets today. You've been through a lot of fear cycles yourself, and I do believe that true contrarian investors view fear as opportunity. But I'm curious to hear your thoughts on that. What would you say to LPs or people that are in a fearful mindset today, whether it's economic uncertainty, maybe looming recession, COVID just happened, and what's kind of helped you in those trying times?
yeah, I mean, I think specific to entrepreneurship, you're seeing a lot of capital pull back, right, in this moment and say, well, it makes sense because there are probably also good opportunities in public markets, for example, right? It might be a good time to go put money into something that has worked for a long time. Um, but like cliches become cliches for a reason, right? Like great companies are started in down markets all the time, and the trick is to be investing the same way through all of that because you can't time the market, right? And the companies we're funding today are going to exit in 5 and 10 years, not this year, right? And so the market's going to be unpredictably different. I think you have to have a plan and stick to it a little bit, which is why you see Techstars in these moments through the pandemic. Yeah, we had to go virtual. We had to do all that stuff. We're growing at the same rate as we've been growing for the last 5, 10 years, right? Trying to do more, do it in more places, but use the model that we know works. I think that's the trick for investors in down markets. It's not like to say, oh my God, let's go all in because this is a moment where there's opportunity. It's to continue to do what you do and build up expertise and knowledge um, in the down market, because if you stop during that, you probably are missing a lot of opportunities. Anytime you're trying to time the market, um, that's really, as an investor, what I really don't have belief in anymore. I think you have to be in the market. You have to take the returns the market is giving you. I think you can get lucky, and you can also get unlucky if you're trying to time the markets.
Yeah. You see this in crypto a lot, right? Where the bear markets are actually the most enjoyable times to have conversations with the highest quality teams. You also see this sector of projects that launch really to just make short-term gains and then kind of go away or take advantage of momentum in the markets. Those tend to go away as well. And so I think actually in these bear markets, fearful times, you get higher quality of entrepreneurs with even greater levels of conviction because they have to, because they're launching something at a time. In general, like I said, I think people are very skeptical of what entrepreneurs are doing in the sense of, when you take somebody that's taken a corporate life path, it seems insanely risky and kind of like this crazy thing to do. When there's a fearful environment, that's even more true. So they're getting all this societal and friendship feedback that's basically saying you shouldn't do this, maybe go get a job or something like that. So the ones that emerge from there, I feel like, are just like they just kill it when they're successful and everything lines up.
The other way to say it is more signal, less noise, right? It's easier as an investor to find the people who are actually truly committed. There are fewer companies in the market, so it's easier for those entrepreneurs to attract the best talent, right? Because people are like coming out of things that aren't working or only want to be attached to things that are promising. So, yeah, there's certainly no reason not to invest in down markets, particularly in the venture capital space or any sort of early stage high risk space. I think the mistake is to stop and wait for the market to come back,
Right.
because you're really missing the entire pipeline of what's going to be valuable when the market does come back. And that's whether you're an entrepreneur or an investor, it doesn't matter.
Right. Like I always tell people, everybody says the same thing, which is, everybody can repeat Warren Buffett, which is be fearful when others are greedy, be greedy when others are fearful. But what most people don't realize is how hard that is to execute for a variety of mostly mental factors when it's time to actually walk that walk.
Yeah. Yeah, it's more than just mindset, right? I mean, resource constraints are real. You have, for example, large endowments that have a lot of capital and they had 60% exposure to public markets, and that shrank in half or whatever,
Yeah.
right? During the pandemic, that puts pressure on other things, right? And so you do have real allocation issues that are out there as well. But for an individual thinking about it, right, it's almost a no brainer, right? It's like, well, the question I love to ask myself when I'm thinking about something really different, taking a risk on something, is what's the worst thing that could happen?
Right.
And in the context of Techstars, the worst thing that can happen is we're going to lose $120,000,
Right.
right? That's okay. Willing to take that risk. Let's learn about it. Let's try it. And that leads to entire new categories of opportunities. If you're someone who's quitting a job at, you know, whatever company you're employed at to go be an entrepreneur, you might say to yourself, what's the worst thing that could happen? Well, you spend a year or two, you don't make much money, and you go get a job again, right? And now you've had an entrepreneurial experience, which probably help you in the corporate context. I think that's a really good question for a contrarian to ask themselves. What's the worst thing that could happen?
Well, and it's a testimonial to the power of diversification is that by diversifying so much, right, which Techstars is like a super example of that, then the worst case scenario is even smaller, if that makes sense, for overall impact on performance in the portfolio.
That's right. Well, you want to hear something that's really crazy in the data. I'm sure you're familiar with Monte Carlo simulations, but if you're listening and you're not, it's this idea of like, let's take the data and run it a million times, right, in a simulation of like randomness, basically. So we did that with our entire portfolio, right? We said like, well, what if we pick 800 of our historical 4,000 companies at random? And how would that perform, right? How would that look? And we do that a million times in a simulation, and it performs a certain way. And then we said, well, what if we took 600? We must be good at picking, right? Take 600 and see how that sort of works. Like they're all good companies, right? Well, 600 doesn't perform as well, right? If you take 1,000, it performs better than 800. And we haven't actually found where that starts to go the other way, where it evens out and becomes, okay, there are enough companies in a portfolio. So it's really counterintuitive, but the more you put into a portfolio, the more not only consistency you get, you narrow the range of risk. You actually get better IRRs and better performance because you're more likely to get lucky and hit on the big companies that are in those 1,000, right?
Right.
Which make a difference in the world. So, it's back to the data thing. It's back to the contrarian thing. It's like a lot of this stuff is really counterintuitive, and where we think there's risk, there's not always risk, right? What's the worst thing that could happen?
Right. Yeah, exactly. That makes a lot of sense.
It's different from jumping off a building. What's the worst thing that could happen? You could die.
Right.
That would be bad.
Right. But one of 1,000 dying or 10 of 1,000 dying is not that bad of outcome.
It's really bad for the one.
Yes,
but
of course.
they'll go on to do things as many of the entrepreneurs do. When they fail, they go on to do something else that's really big. And the trick is failing quickly so that you can get on to the next thing. But for a portfolio, yeah, it's not bad at all.
Well, I mean, that's what I tell startup companies when I'm mentoring them or giving them advice. I say, listen, I'm here to help you, but it's way more detrimental for you guys if this doesn't work out than for me. So the stakes are higher for you. So do what you see as the highest probability for success. And it kind of comes back to full circle what we were talking about from mentoring. It's like, I'm here to give an opinion. If it's helpful, great. The repercussions of me failing is far less than you failing.
Right. And it's all, it's not binary. It's I'm going to tell you what I think, and I'm either right or wrong, but very likely there's sort of more gray to it than that, right?
Yeah.
You may have to synthesize what a lot of people are saying to really figure out what's best for you.
Right. What tech trends are you most excited about coming up?
Look, I mean, everybody in this moment, right? It's all about AI. It's exciting and terrifying.
Yeah.
And people ask me what percentage of your portfolio is AI this year. I don't know, 80. I mean, it depends how you look at it, right? It's almost become that thing that mobile was, 20 years ago, however long. Like you have to say you're mobile because otherwise you're not the thing that people care about. And what we realize is that mobile is just an attribute of a thing. It's not what the thing is. And I think that's what's going to happen with AI is, there are companies that are going to leverage data and modeling and predictability, and there are companies who aren't, right? And the companies who aren't are going to struggle with that over time as that technology matures because they're not going to make as good of a decision on things. And so, again, you squint at the portfolio and say, yeah, everything is either talking about or really using some form of AI. And it's getting easier to use because, the infrastructure is there now. You don't have to build it yourself in all cases. It's going to get much crazier in that world. So it's exciting and terrifying, which I think all interesting technologies are.
Yeah, AI is not a business model.
That's right. It's a thing. It's a technology you can use to make better decisions. That's how I would think about it.
Right. 100%. Well, David, thanks for joining us. Really had a lot of fun. If people want to find out more about Techstars, what's the best way to do that?
If you can't find us, you're not trying. It's just techstars.com. I'm easy to find on all the social things. Usually as David Cohen. And you're always welcome. Anybody's welcome to email me if any of this strikes a chord or you want to know more. I'm just David at techstars.com.
Awesome. Thanks for joining us.
Thanks for having me. Good to be here.